A new phase to the AI bubble has just begun, one which has the prospect to be bigger, more explosive, and even more destructive when it comes to crashing down in 2026. At first, the hype with AI was massively concentrated around the AI companies themselves. OpenAI and Perplexity or Claude and others making the software for AI, convincing the world that everything was going to change. But then the last year, 2025, was really characterized by the data center bubble. Companies like Oracle and Nvidia exploding in value based on the idea that AI needs to run on basically big computers. And these AI computers were essentially the builders or the operators of those computers. Now, though the winds have shifted once again, the hype around data centers is pretty much at all-time highs with nowhere to go but down, and so investors are switching tacks. Now they're pushing a new phase to the AI bubble, hoping that the artificial demand they create for this sector will be enough to save their skin. And unfortunately, there is one massive overarching problem and reason why this will only end in disaster. AI doesn't actually make anyone extra money, and that seems to be a trend that isn't going to change. The AI trade is moving, and investors seeking cutting-edge ways to play it are snapping up technology pick and shovel stocks as massive cloud service providers pour billions into new data centers. Data storage companies dominated the S&P 500 in 2025, with SanDisk shares soaring almost 580% to make them the benchmark's best performer, with Western Digital in second place and Seagate Technology in fourth. When the benchmarks are fairly concentrated, it's important to look for themes that are going to drive sales and earnings growth. Portfolio manager coming from a portfolio manager at Allspring Global Investments. AI is kind of one of those dominant themes right now. That's nothing new, so we're just broadening our horizons beyond tech. Investors can find room to grow and better valuations by buying into the next wave of companies that are set to benefit from the billions of dollars hyperscalers are spending to build data centers. What we are focused on are the picks and shovels of where that money is being spent. The chips to a degree, but more so some of the names that you haven't really heard of. So the trend for AI in 2023 was OpenAI, right? And then it moved on to, say, Nvidia for 2024, then Nvidia plus other chip manufacturers in 2025. But valuations are so insane that they just can't go much higher. So investors in this AI hype, this realm, they're looking for the next movers from the AI hype to see massive gains to inflate the bubble further. And they hope that they can get rich and get out in time before the bubble pops. Now, data center operators themselves and the first line in the supply chain, they're two obvious plays from this, and the old plays they are now, according to those investors. Everyone knows that Nvidia chips are used for data centers, so that's all priced in. So there's no upside to Nvidia anymore, according to these investors, because it's all priced in at the top of the current bubble. And so now they're looking for new directions not yet explored. Things really weird, like Bitcoin and cryptocurrency miners and construction companies and digital storage and heating and cooling companies and what they call the picks and shovels. And this really goes back to that old adage of, the people who actually get rich in a gold rush aren't those mining for gold, it's the ones selling the gold miners, the picks and the shovels. That's what they're looking for with this right here. So, of course, there are some fears on Wall Street that the spending could slow, reversing gains in stocks tied to AI. It's similar to what happened during the pandemic when demand for basic home health products took off. COVID hit and the world needed way more face masks, hand sanitizer, all those things. But within 6 to 12 months, there was a glut and those businesses that supplied those things went from the best times ever to the absolute worst times ever. Still, investors remain bullish on the AI trade as the hyperscalers keep pledging to spend. Here's what investors are buying now to play the tech infrastructure build-out. They're specifically likening this shift here to what we saw during COVID, right? A big change overnight that requires a big shift in manufacturing and spending, like a new virus spreading across the world, or in this case, new AI technology or thinking machines. A massive rush to build the stuff for that shift, right? Like face masks and hand sanitizer and other medical equipment for COVID versus the computer chips made by Nvidia to run the AI today. But the glut and rush that led to overproduction, oversupply, too much hype, and so that demand was met for a while, but only because of that hype or that excitement or that panic. Once that exuberance has disappeared, Well, demand for this new equipment, it dries up and disappears and the companies suffer. And with COVID, we saw literally, right, warehouses and warehouses full of masks and hand sanitizer just sitting there empty because no one wanted them anymore. And the fear with the AI bubble is the exact same as about to happen with these AI hyperscalers, right? They're spending hundreds of billions of dollars building out the first layer of infrastructure for AI, but they don't know if AI will ever even be profitable, or if the demand that they're seeing right now is real, or if it's inflated by excitement, by exuberance. And so the trade that's being pushed by the AI crowd now is going one step deeper. The first level of suppliers for the AI bubble, they're already as inflated as they can possibly get, so they're going for the second level and the third level of this bubble. Wall Street expects data storage to remain hot in 2026 after SanDisk and Western Digital and Seagate surged. However, the boom times for this year's winners may be coming to an end. For example, the average analyst price target for SanDisk for the next year is $264, which is just an 8% gain from where it currently sits. Analysts see much bigger upside in a company like Pure Storage, which is trading for $68 but is projected to reach $94, a 38% leap. So, SanDisk, as an example of one of these first level of AI hype, is only expected to rise in value by about 8% over the next year, so the investors are going one step deeper. Two companies that can still claim to be in this AI bubble, that will still claim to get access to these massive deals and this inflated revenue, but who haven't yet realized they can do this. And they haven't yet had that price spike and the investors price that into their markets, so the potential gains for them far, far greater. So what are these new areas that we're going to get caught up in the AI bubble? Well, according to the media, it's construction, cryptocurrency miners, heating and cooling companies, and then software companies as well. So let's run through a few of these. Construction and power. A range of stocks associated with building and powering data centers are expected to keep running, like Quanta Services, which provides specialized contracting for utilities and telecommunications companies. Companies involved in wiring are also popular. They include Amphenol, which designs and manufactures high-speed fiber optic cable and copper interconnect solutions used in data centers. Next, we have Bitcoin miners, right? They represent apparently a potential revaluation story as they pivot towards powering data centers and away from mining cryptocurrency. They have the electricity already. They've had it for 5+ years to produce Bitcoin. They're going to redirect their electricity to higher value, long-term contracts for high-performance computer hosting. Heating and cooling. Data centers require specialized precision-controlled heating, ventilation, and air conditioning systems, creating demand for the companies that make them. Right? Vertiv Holdings, as an example, which provides power systems and cooling systems for data centers, is up 45% in 2025. And then software. Some investors with longer time horizons are looking to software as future beneficiaries of AI as large language models improve and more applications are built. Investors are, I think, naturally inclined to look for companies that have cheaper valuations with terrific magnitude of growth, but are potentially going to really benefit from the application of AI. Now, the most interesting thing about all this is how loose a lot of these investment theses are, right? Investing in more software because of AI. The idea is that AI gets better, and so more applications for AI are created. And so investors are just looking for new hype, and they're just guessing which software companies are going to benefit from these not even created AI applications yet. They aren't even considering the fact that these software companies themselves, they're not going to own the AI. They won't own the physical infrastructure for running the AI. They will just have to license and rent access to the AI, which really turns the benefits of software companies on their head, right? They'll have higher costs, lower moats, and will be dependent on the goodwill of the companies that actually control the AI. And that's if they manage to benefit from AI in the first place. If it's vaporware in a bubble, well, then these software companies will get no benefit at all. Construction companies and heating companies and cooling companies or wiring companies, sure, in theory, these seem like great ideas to invest in on a surface level if they're going to get these massive contracts to build out these huge AI infrastructures. But that's a very big if. And mark my words, within a month or two, we will start seeing some circular deals hitting these more AI adjacent companies, like the heating and the companies, construction ones, like we've seen with OpenAI and NVIDIA over the last year. OpenAI, let's not forget, they're still claiming, despite literally everyone now knowing it's a lie, that they will be spending $1.4 trillion building out data centers, and a huge proportion of that, literally hundreds of billions of that, would have to be spent on AI adjacent companies, right? Construction and concrete and vehicles and wiring, electricians, plumbing, lighting, literally everything that goes into building a building. But those hundreds and billions, they aren't actually going to get spent. AI is just saying it's going to get spent to inflate their value and inflate Nvidia's value, and it creates that great big incestuous circle that we know so much about now. So when a wiring company explodes 200% in value overnight because they agreed a big contract with AI and they put out a press release, take a deep, long look at the details, because the chances are no money will actually ever go into their pockets. The AI bubble will just expand beyond AI, beyond microchips and beyond software, and into the traditional economy as well. Now, I'll admit for a moment here, I am fairly cynical about all of this, as you can tell, but I want to explain why I'm cynical about this, and there's two key reasons. First, there's no real evidence that AI is actually thinking or capable of destroying millions of jobs in the world and creating massive wealth for the AI companies like we're constantly told there is. In fact, there's a lot of evidence showing the opposite. And there's also, the second point, there's also a lot of evidence that the AI billionaires, right, they're trying to inflate the bubble into the too big to fail category so they don't lose their money when that first point becomes widely accepted and the bubble finally pops. And to show you why the first point is true here, there's this really, really interesting article from someone who is at the forefront of AI and actually trying to use AI to be more efficient. So we're going to run through it right now. I know software development. I've been doing it for 25 years. I was an early adopter of AI coding and a fan until 2 months ago when I read a study and suddenly got serious doubts. In that study, the authors discovered that developers, software developers, were unreliable narrators of their own productivity. These software developers thought that AI was making them 20% faster, but it was actually making them 19% slower. This shocked me because I just told someone the week before that I thought AI was only making me about 25% faster, and I was bummed it wasn't a higher number. I was only off by 5% from the developers' own incorrect estimates. So I started testing my own productivity using a modified methodology from that study. I'd take a task and I'd estimate how long it would take to code if I were doing it by hand, and then I'd flip a coin. Heads, I'd use AI, and tails, I'd just do it myself. Then I'd record when I started and when I ended. That is literally what he did. I discovered that the data isn't statistically significant at any meaningful level. That basically means that there definitely isn't a big gain from using AI. That I would need to record new data points for another 4 months just to prove if AI was speeding me up or slowing me down at all. It's too neck and neck. But also so far, AI appears to slow me down by a median of 21%, exactly in line with that study. I can say definitively that I'm not seeing any massive increase in speed, like a 2 times increase in coding speed using AI coding tools. If I were, the results would be statistically significant and the study would be over. I wish the AI coding dream were true. It turns out though, and I've collected a lot of data on this, it doesn't just not work for me, it doesn't work for anyone, and I'm going to prove that. That's exactly what he does. My argument, if so many developers are so extraordinarily productive using these tools, where is the flood of shovelware? We should be seeing apps of all shapes and sizes, video games, new websites, mobile apps, software as a service apps. We should be drowning in choice. We should be in the middle of an indie software revolution. We should be seeing 10,000 Tetris clones on Steam. Consider this, with all you know about AI-assisted coding and its wide adoption, if I showed you charts and graphs of new software releases around the world, what shape of that graph would you expect? Surely you'd be seeing, or expect to be seeing, an exponential growth up and to the right as adoption took hold and people started producing more. Well, let's take a look at some of that data. The average number of new iOS apps released per month from 2019 to 2025, AI came around here. Literally no increase in the rate of new Apple apps being created. What about the same thing for Android app releases via the Google Play Store from 2019 to 2025? Again, AI adoption starts around this point here, and we actually see a reduction in the number of new apps being released every single month. What about websites? Here we see from 2014 all the way through to 2025 the number of total website domain registrations. So every time you make a new website, you have to register a new domain. Do we see a massive explosion in the growth of websites in 2022 or 2023 when AI adoption starts? No, it's a very consistent, steady line upwards, no explosion with AI growth. What about Steam? New releases by month. Steam is an online video game platform, the single biggest one. If it were, the case that AI made software development easier, it would be far, far easier to create a video game, to release it on Steam to get paid. And we should see a massive increase, an exponential curve going up, but we don't. We see a very slow but steady line increasing in trend with before AI as well. What about new public GitHub repositories bi-monthly? GitHub is essentially a forum for coders to talk with each other and to submit code and get help with one another. Again, there is no increase. It's steady and consistent. The most interesting thing about these charts is what they're not showing. They're not showing a sudden spike or hockey stick line of growth. They're flat at best. There's no shovelware surge. There's no sudden indie boom occurring post 2022 or 3. You could not tell by looking at these charts when AI-assisted coding became widely adopted. The core premise is flawed. Nobody is shipping more than before. Nobody is making more than before. The evidence that's actually available to us, the stuff we just went over there as an example, it shows us that even in the single most AI-excited industry in the world, software development, AI is not actually improving productivity. It isn't making workers more efficient, and if it isn't doing that, is it making companies more profitable? No. Then what does it do? Because it costs money to build this AI, and it costs money to run this AI. It creates artificial wealth in the stock markets, right? Based on the idea that it might change the future and the idea that it might make companies or people very rich in the future. But the evidence shows literally zero improvements in the number one industry where AI is claimed to be revolutionizing the world. Why aren't people talking about this yet? Well, because there's a placebo. People think they're more efficient even though they're not. And no gains have actually been measured yet, but that's, widely excused by the legacy media and the bubble, proponents as an example of low adoption or a lack of understanding or just it's outright ignored altogether. But the AI billionaires, the companies which are pushing this bubble, they know this is the case. So they're desperately trying to hide this and to grow as much as possible before the markets start to price this vaporware accurately. And that ties in with the AI industry's aim to become too big to fail so that a government bailout picks up the pieces, keeps those companies solvent, and keeps the elite wealthy at our expense. And again, there is actually a lot of evidence to support this idea. We had that infamous statement, right, made by OpenAI, literally asking for a federal backstop before backtracking and then trying to, take back those remarks a while ago. Sarah Friar, OpenAI's chief financial officer, said the company, which owns ChatGPT, could seek a federal backstop or guarantee that could allow it to borrow more money at lower rates. The company's pitch for government support could be strengthened by concerns that the US economy is being propped up by vast spending on AI. And we've got the Wall Street Journal explaining how the AI business is kind of already getting a bailout. Despite lukewarm market signals, the US government seems intent on backstopping American AI no matter what. Trump administration is rolling out the red carpet for these firms. The administration's AI action plan aims to accelerate AI adoption within the government and military by pushing changes to regulatory and procedural procurement processes. Government contracting offers stable, lucrative long-term contracts, exactly what these firms will need if the private market for AI dips. Washington is trying to shield AI companies from regulations. The White House's action plan seeks to limit federal and through funding reviews, state regulations on AI. The US bailout doesn't stop at the border. The Trump administration last month kickstarted the American AI Exports Program, through which the White House will mobilize tech, financial, and diplomatic resources to push US origin AI onto new foreign markets, specifically selling to foreign governments. So the US is already giving huge regulatory favors to the AI industry, giving them stable, decade-long, billion-dollar contracts, giving them the promise of that stability that comes with those contracts, and in essence, guaranteeing that they don't go bankrupt if the bubble pops. There are fundamental shifts going on in the economy right now. The AI backstop is sort of already there, And markets and economics, everything is changing about investing. That's exactly why, for example, actually gold, silver, and copper outperformed the S&P 500 over 2025. That's exactly why so many active investors outperformed the S&P 500 last year. And you may have noticed that actually over the last couple of months, I haven't been making videos as reliably as I usually do. And that's for a good reason. It's because I've been building an investing playbook based exactly on the fundamental changes to the macroeconomy that I'm witnessing. And I'm finally ready to share that playbook with you as a limited time only and free end of year gift. This week, I'm going to be running a free live masterclass going into far more detail about these fundamental changes to the global economy and markets, giving you all the data that proves without a doubt that this is the case, that the macroeconomic conditions that gave us the last 20 years, they're changing and they're gone. And also, we're going to establish exactly how you can not only protect yourself from the changes that are going to come and that are already coming, but also how to actually profit from this changing financial paradigm as well. Now, I've run some of these online classes before, but never about something as crucial as this, and usually only open up 100 spaces for these classes. But this time around, we've opened up 200 live spaces instead. So if you want to learn more about this entirely for free, simply by sitting on a call with me, going through all the data and the evidence and laying out the exact way I'm investing my money going forward for the next few years, my predictions for what's going to come and the data to back all of that up, click the link down below in the description and you can register for the masterclass and save your space for free. Again, there are limited spaces available. The software literally can only handle 200 people on the call at once. So once those slots are reserved, it's closed. And I'm only running this as a special event as we are ending out 2025. I'm not going to be running this masterclass again after it's done. So don't miss out. Click that link down below now and register to save your space before we're booked up. Again, link is down below in the description of this video. Follow the steps on the next page after you click that link to save your spot, and I'll see you on the masterclass very shortly.